Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for January 25th of 2021. Please see our disclaimer for important information. As we start off the chart pack this week, and we do have quite a full slate of interesting charts that I'd love to share with you here. We always start with our COVID tracker, and you see the little bit of noise that we've had here in the data over the last month. Clearly, we're seeing a downtick in the 7-day moving average of daily new positives. And I think that's coming off kind of that interim peak post-holiday. We're seeing a little bit of a rolling over in the 7-day moving average of daily deaths. Obviously, we're still in a hospitalization utilization problem right now across many areas of the country amidst the rollout of the vaccine. But you can see that daily death number typically comes at about a 2-week lag. And so good news is we're seeing a downtrend in both of those categories. Here's a chart with data from the CDC, chart from covidtracking.com, just showing deaths by various causes in 2020. And this is data that's very easily accumulated and tracked. You can see that, despite all of the headlines with the pandemic, which obviously are very much warranted, you can see that, still cancer, heart disease continue to kill quite a few Americans. And obviously Alzheimer's, dementia, stroke, so on and so forth, are all causes that, you can kind of get a sense from this chart of where COVID fits into that. Now, again, these cancer, heart disease numbers, these are annual numbers, so very profound numbers. And COVID is kind of like this point in time issue. And obviously, we're going to have some more carryover into 2021 until we get mass vaccinations going. But just thought I'd share this for perspective's sake. Vaccines by country. Obviously, there are some countries that have done extremely well. Actually, Israel and the UK are too. Now, these are aggregate doses administered. So while the US in that orange bar, total COVID-19 doses administered, looks much higher than those two countries. As a percent of the population, Israel has done a phenomenal job out of the gate, as well as the UK. Now, Germany is doing a good job amidst, the backdrop of Europe, which has really not done a good job to date on vaccinations. But you can see that blue bar is beginning to perk up. These are the second doses that are being administered. So obviously we'll want to track this very, very closely. This is really the theme and the stimulus behind 2021 in so many different respects. This is a chart that I pulled from First Trust, and it's got data from a lot of different sources, but very, very interesting. And I'll try to kind of capsulize it by this. On the left-hand side, you've got millions of people. And so right now, on the right-hand side is basically a percent of population. So if you look at the blue bars at the bottom, that represents positive U.S. COVID tests. Essentially, just dating back a few weeks. This is, December 20th of last year. And just as on literally the eve of vaccinations, and just the first vaccinations were going out at that point in time. So CDC in that gray area estimates that you have, upwards of perhaps 80 million people that have been infected, whether or not they know it. This is just assumptions from data that they're making to say that, we've got a lot of infections out there that perhaps weren't reported, people were asymptomatic, so on and so forth. And then above that, the green bar represents the vaccine doses that are being administered. And so all of that tracks to the left-hand side of the chart. Now on the right-hand side represents that orange line that sits above all that. And that is the estimated share of US population with antibodies. And so this it kind of speaks to this trend that we're aspiring to in terms of herd immunity. And obviously vaccines are going to help with that. But right now we kind of sit about maybe 37% if you assume that the CDC's data is correct, and you've got perhaps 80 million people that have had it, didn't know it, asymptomatic, so on and so forth. But that number, as it's widely being reported, you've heard Dr. Fauci, really needs to be close to 75, 80%, perhaps, maybe a little bit more than that. And so you can see that we still have a lot of room to run there. And obviously that green component with the vaccines being administered really needs to perk up. I pulled this chart out of, well, this is actually from Deutsche Bank. And it's really interesting because a lot has been made over Pfizer and BioNTech and their remedy, as well as Moderna. These are therapies that require multiple doses, have to be stored at negative 70, 80 degrees Fahrenheit. But we do know that we're on the cusp of having submittals by both AstraZeneca and Johnson & Johnson for emergency use authorization for their own therapies. Now, the J&J therapy is unique in the sense, and it's not an mRNA type approach, which is what the Pfizer and Moderna has done, but it doesn't have to be stored at ultra cold temperatures. It can be stored in a regular refrigerator, and it's a one-shot therapy. And J&J has the capacity to really ramp up production. Not that Pfizer doesn't, but J&J is, and they can get more shots in arms with a single dose. And this is just kind of layering all of those different EUAs on top of each other that we assume, obviously January, we're just on the front end of all of this. But as we get EUAs for J&J and for AstraZeneca, you can see how they layer on top of each other. And so this goes back to what I said in that prior slide, that if we get to 80% of U.S. citizens vaccinated, this is kind of this area where people are talking about herd immunity. And even by the summer, we can get maybe 40% of the population vaccinated by at least one of these EUA drugs that are out on the vaccines that are out on the market. Vaccines across America. Again, from Bloomberg, we've shown this to you before, just thought I'd update it. Some states have done a really good job in terms of canvassing its population with vaccine coverage, and some of the ones that have done a good job, inherently have lower overall populations, like Alaska, the Dakotas, etc. Some of the more highly populated states, again, if you look at California, it's kind of lagging behind. Texas doing a little bit better job. New York doing a little bit better job, but Massachusetts next door is not. And so it's very uneven. Again, this is something that we expect to see evolve with the Biden administration. Again, taking politics out of this, but Trump had really relegated a lot of these decisions to the states. And so it was inherent that you're going to see some uneven distribution numbers, kind of what this chart represents. But the hope is that perhaps with a nationally coordinated strategy, again, all politics aside, but if you have something that's centrally managed to distribute, you have a unified chain of command on the distribution side, that maybe this chart kind of evens out in terms of its tone here over the next couple of months. There's some various information here. So it just, we've talked a little bit about households and how they've fared through this. And obviously I've got some charts on small business, but I want to focus on just really what the data tells us in households. But you look at, on the left-hand side, household net worth in trillions of dollars has really spiked since the end of 2019, even during the pandemic here. A lot of this has to do with the stock market. And its recovery. You can see that dip there in March, so that represents the stock market going down, but also housing prices. So household net worth has fared okay, and actually looks good. Now, if you look on the right-hand side in the upper right, you've got household cash, checking, and savings deposits as a percent of GDP. And this time series goes back to 1950, and you can see how it's kind of jockeyed around. But really spiked over the last year. So it's not just the equity market, and it's not just the housing market. It's actually cash in the bank. And so savings rates overall, which is typically what you see in a recession, but in this kind of shock recession that we had, you saw a lot of people save money, put money away, etc. Now, down on the lower right, you can see excess personal savings in the U.S. And if we're going to go under the assumption that we're going to get a stimulus bill, which will drive $1,400 checks into the bank accounts of Americans, again, notwithstanding household dollars being more than that, but you can see that number, that kind of that yellowish line that tracks December, January, February, is really going to spike, and it's just indicative that we're going to have somewhere close to $2 trillion of excess personal savings in the U.S. By the end of February, if we get this follow-on stimulus bill with the stimulus checks. Now, what does this all mean? So in a nutshell, it provides a lot of feedstock to consumer confidence numbers overall as we track in. If we get better economic data, then, and obviously if the stock market, with some turbulence expected, kind of holds its head, I mean, consumers are going to feel pretty good. And if they have this pent up supply of funds, if you will, I would tend to feel a little bit more optimistic with regard to consumer spending as we track later on this year. A quick comment on the unemployment rate. We know those numbers, have obviously come down. We've seen a little less traction in the labor market at the end of the year. Some of the momentum kind of waned. We had an uptick after many, many readings of lower unemployment data, and it just is kind of flatlining for the time being, and until we get that next wave of reopenings and things like that. It's just going to be a little noisy from here on out. But I plot these two next to each other, and it looks like in some respects it's the same chart, but it's actually not. So on the left-hand side is what they call the U3 unemployment rate. That's what gets reported in the data. That's what gets reported in the news. That's what, when we wait for the report on the first Friday of every month, this is the number that you hear in the headlines. Now, the number on the right is called the U6 unemployment rate, and that's for people that don't have a full-time job that would like to have a full-time job. They're working part-time, and so on and so forth. So they're what they call underemployed. And so this number is tracked very similarly, but you can see, for that cohort, of folks that don't have a job, a full-time job that would like one, that represents almost 12 million people still. So, I mean, you can see that number was down to around 7 million. So, we still have a gap in this employment, just as we do on the traditional U3 rate there. And it's going to take us a while to get there. But there are a lot of folks that are beginning to kind of do that analysis and kind of figure out when we should get there. This is it's a moving average chart of moving averages from Homebase, and so what it does is kind of give you a quick snapshot, the health of the small business sector. And we had a pickup. We had some progress as we got through the summer and the fall, and that kind of leveled off. It did level off, but then it kind of slid back down. And those two dips represent the holiday periods, and we're struggling to kind of get back to where we were this summer. And that was kind of a happy spot, if you will, even though it was down 20% year over year. I think people felt a little bit more optimistic, but we really need some of the stimulus dollars that's going to help small business owners that are facing an existential threat right now. And this is something I've said consistently throughout these charts of the week programs and my market minutes comments throughout the year. But we're really at a kind of an important inflection point here. We've got to find a way. This all goes back to vaccinations and getting the economy open, of helping these small businesses and employees. I thought this chart was really interesting because it kind of gives you a breakdown of the impact of the impact of labor during the pandemic. And this is from the Economic Policy Institute, and it kind of shows a snapshot of roughly 27 million workers. And when you've got, basically 11 million that are officially unemployed, you got 7.5 million that are having to deal with some cut of some sort, and then you've got folks that are either miscategorized or have just frankly dropped out of the labor force altogether. But an interesting snapshot of this impact, and much of this is in the small business sector. So this is a employment recovery path. So this is what I was referring to a few minutes ago about a lot of the investment banks, a lot of the economics. This is the Bureau of Labor Statistics and Oxford Economics, as well as Haverty Analytics. They're drawing some conclusions that we get back to where we were at the beginning of 2020, perhaps by the first or second quarter of 2023, in terms of labor, just in terms of labor. And that gray dotted line that's upward sloping is where the path that we were on before COVID hit. And so, it's going to take us a long time to kind of reattain that glide path, and it would insinuate a lot of outsized growth, which I don't think that's in the cards. I think, once we kind of clear out the noise from this massive dip and then this snapback, kind of recovery in the data, that looking ahead, it's just going to be a bit more muted because, we've got the drag from all the unemployed folks, the small business sector. Then we're going to have probably some access to capital kind of constraints that are going to impact our ability to kind of reattain that line. But, again, just from a purely estimate standpoint, where we are now and where, we would hope to reattain that pre-COVID level, it's just going to take us perhaps a good 2 years to 2.5 years. A quick comment on retail sales. The data that came in here recently was a little bit lower than expected. We were expecting a little bit of a soft patch, if you will, in retail sales data, but it was a little bit greater than expected. You can see here retail sales ex auto and gas was actually down 2.1% when it was expected to be down just slightly. And then this more kind of focused control group, if you will, was down almost 2%. And we know from the prior slide that we've got a lot of seed corn, a lot of dry powder on the sidelines, which I think will help fuel consumption and sales at the retail level into 2021. But right now you can see that, we had that large dip and then the huge bounce back. We had a lot of durable goods spending. This is not necessarily that. This is retail sales like, grocery, and other type of retailers, notwithstanding the fact that apparel was down quite a bit, but convenience stores, drug stores, those types of things, and that data, there is a law of averages that kind of catches up with you. So we were expecting a little bit of a soft patch, kind of 2 consecutive periods of a little bit softer data, but this data was a little bit more than expected. Now we'll get into some comments on inflation, input costs, producer prices, so on and so forth, and how this is supporting this notion of increased inflation in the pipeline as it moves from production to retail as we head towards the end of the year. And this is very much being built into the markets already. So I've got several examples to show you here. Heavy metal scrap. This is just, scrap steel. So scrap steel is used in the manufacturing of durable goods. You think of like a washing machine. People aren't making new steel for this. This is, a lot of refurbished, reclaimed steel that's being sold on the secondary market. And so, sometimes you have supply and demand issues that cause, if you're at low supply on scrap, the prices go higher, but in this case, there's just a lot of demand because durable goods manufacturing is really strong. So strong scrap prices which also make automobiles and other things. And then you've got on the right-hand side, you've got the Institute for Supply Management Manufacturing Index, prices paid, and these are for components. So you can see the red dotted line there, ISM manufacturing prices. You can see that spike, scrap is an input into that. There's other things, industrial metals that go into that. I've got a chart on that. But you can see the headline inflation, this PCE number, is kind of lagging behind that. So this is just one indication. You see that red dotted line going up, and that kind of that blue solid line just kind of trailing behind. I think there's going to be a catching up at some point. We'll see more price inflation coming out of the production pipeline here later on this year. This is a continuation of this theme of producer prices being a little bit higher. So on the right-hand side, we've got metals prices, and these are industrial metals. You can see copper futures down below, and you've got iron ore prices, which really kind of dovetails with this theme that we saw in the last chart with scrap steel prices. So all of these metals-oriented input costs are going up. And then on the right-hand side, you've got, in the upper right, you've got board composite prices, and these are strand board. I mean, this is basically a lumber proxy. So lumber costs are high. We know we're doing a lot of home building, which drives lumber demand, but those costs are high. Even cotton prices on the textile side are high. Now this is, if you look, and this chart basically goes back to the beginning of the year, and they're much higher, relatively speaking, than they were at before the pandemic, which is really interesting because retail apparel has really not done that well. But you can see that all of these input costs are going up, and I think what this means, that the read through on this, that just the magnitude of the magnitude of the price increases here. It's going to make it really hard for producers that are bearing these input costs to absorb these costs and not raise prices on the consumer side. That's what they've done in many respects during these little commodity input shocks, heretofore over the last decade. But I think the magnitude of these increases is going to make it really impossible for them to withhold that consumer price impact. And they're going to have to pass at least some of this stuff along to consumers. Food prices. This is an index from the United Nations. This is a global food proxy, and it just continues to go up. You can see that there's really, if you go back even 5 years, I mean, we're in rarefied air right now. So yet another input into this overall potential inflation basket. This is consumer prices. So on the left-hand side, I've got the overall number. On the right-hand side, we've got the core CPI, which is ex food and energy. In both of these cases, you can see that we're below what the Fed would like to see, and that's 2%. And what they've said is that they would, keep interest rates low until they see kind of an average of 2% over a period of time. And they didn't define what that time was, but they just said they need to see it consistently above 2% for a while before they raise interest rates. And so, as you can see here, if you look at core CPI, and the Fed uses something slightly different. It's called the Personal Consumption Expenditures, or PCE index. So this is the CPI numbers, what you see in the headlines. And it is a close relative to what the Fed looks at, but you can see that number's about 1.6 on the core side. And so it's got room to run, even though we've had this pickup in prices from this, the depths of the pandemic. We still have a ways to go before, I think anybody's going to feel confident in the Fed raising interest rates at the short end of the yield curve. This is an interesting chart. I wanted to show this because it speaks to two different things. On the solid black line, this is the Baltic Global Index. This is a freight index, shipbound freight, it's a function of trade, of global trade, which we know has been depressed. But it's nevertheless an index which is really helpful to kind of gauge the health of the global economy, or at least the expectations for trending in that direction. So this is an activity index, if you will, and it's really gone up. We know there's been a lot of durable goods manufacturing and demand across the globe, notwithstanding just the U.S. So Baltic Dry Index is really looking good here, but inflation is down, and you can see that there's a reasonable relationship. It's not a tight relationship, but there's a reasonable relationship, and it's really odd to see where we are now that you've got this Baltic Global Index really spiking, and global inflation really looking relatively weak. So again, this is another one of those charts that you've seen me show you over the last few months, where you've got this odd divergence that at some point something's got to give here, and I think it's going to be the inflation side a little bit. This is a chart on inventories. This is Evercore ISI, and I pulled this out, and I think it's a positive read through. Now, we talked about inflation, and that's not necessarily great for equities unless it's well, especially if it's unexpected inflation that rises and materializes rather quickly. If we can see inflation kind of begin to perk up, gradually on the horizon, that's not necessarily a bad thing, and not immediately putting equities in danger. But on this slide, I would take this as a positive for GDP and economic growth, because inventories, when they're this low, and this is a company survey, when companies tell you inventories are low and you're in the midst of kind of the synchronized global economic recovery, well, you're going to have to replenish those inventories, because you have to assume that demand is going to pick up. And so this chart right here makes me feel really good about the ability for economies to kind of pick up production levels, because frankly, they've just got to replenish inventory. A couple of charts here on defaults and bankruptcy filings, and there's kind of maybe some things that are a little bit surprising here. So on the left-hand side, this is Chapter 11 and Chapter 7. And Chapter 11 is reorganization, and essentially Chapter 11 is just liquidation. So you can see that in the dotted line, we've had a lot of filings, for that have spiked. This is, the big spike there is in the global financial crisis, and you've got to go all the way to the right side to kind of get into the pandemic. And surprisingly, those have been relatively low. Chapter 11 filings, perked up a little bit, but again, they're nothing like what we saw in the global financial crisis. There's one particular read through on this. And it also applies to the chart on the right, which is global defaults, is that, we really haven't seen that as much stress in the larger company area that we have in the small business. So what these charts really speak to is, kind of that impact in that medium to large size business cohort. In a lot of cases, small businesses just really fold up, and there's not a filing involved, but they just kind of fold up, if you will, because there's really not much to reorganize or not much to liquidate in many cases here. But on the right-hand side, you've got global defaults, which very surprisingly, and I would not have estimated this back in April, May, but global defaults actually finished the year below 2009 levels. And this is a global indicator, whereas the one on the left-hand side is just for the U.S. But just even still, you look at the U.S., it's not as bad as it was. It's I think we in some respects may have dodged a bullet, that this credit cycle is not nearly going to be as disrupted by the pandemic as we thought it was. Now we'll start talking about the markets here, and we'll start with this one. This represents equity and fixed income exchange traded funds (ETFs), which we use quite extensively here at BKA, and it shows you the exuberance over this prospective recovery, the synchronized global growth that we've been talking about, which I do think is a real thing. But you can see in anticipation of that, all of these massive fund flows. And I think to some degree, a lot of this optimism has already been priced into the market. And we've got several charts to show you which seem to corroborate that. But this is one. I mean, and this time series goes back to 2012. So it's not quite, back to the global financial crisis, but you can see, with some, degree of repetition, we go through these ebbs and flows of fund flows into ETFs, but we haven't really seen anything like what we're seeing right now. It's very interesting. This is equity fund flows. This is just money that perhaps is coming off the sideline into the market. We've always talked about this pool of liquidity in the Fed and monetary policy adding to potential asset inflation. This is really the manifestation of it right here. Liquidity sloshing around the market, looking for a home. A lot of folks looking at, I say folks, but institutional or individual investors as well as institutional investors have kind of determined that maybe the equity market is, the TINA approach. There is no alternative, and so you see these fund flows rolling into the equity market. Again, just another indicator of this exuberance that we're seeing heading into the new year. I found this and thought this was extremely interesting. Very little attention is paid, relatively speaking, to penny stocks, and these are, as the name would imply, very small publicly traded stocks that have very thin floats, meaning that there's not much stock out there to trade. And we in the industry, we kind of say that these things trade by appointment, because sometimes if you wanted to go out and buy one of these things, you'd have to wait days to find somebody who is willing to sell it to you. But these are very small stocks, fly under the radar, trade in what we call the pink sheets, which is, you can find a quote on your phone, but you won't find very many of these things in the news flow. But having said that, the volume in these things has really gone nuts lately, and almost unprecedented. You've got a whole investor class out there that has suddenly become enamored with trying to find the best trying to find the next Tesla in waiting. And in a lot of cases, these penny stocks are just literal value traps. Now, again, you get enough volume like we've got here, it'll drive prices higher, and it's almost a feeding frenzy and a self-fulfilling prophecy that you've got people that put money in, drive the price up, which attracts more people and potentially creates a bubble. And so while I chuckle at this chart, I am concerned too about this froth and all of these fund flows driving these prices higher. It just makes me think consistently that we're going to have a little bit of churn in the market because I think we're sitting on a bit of a froth right now. Nasdaq Composite Index, again, this is more technology stocks, which have kind of, after a little bit of a choppy period, have kind of almost reasserted themselves to some degree. And this is the percent of the members of the Nasdaq Composite Index that are above their 200-day moving average price. Again, this is an industry bellwether analysis tool to kind of look at the health or the froth in the market. And as you can see, you've got to go way back into 2003 when we came out of the tech bubble, if you will, that multi-year tech bubble. You've got to go all the way back then to get to where we are now in terms of the degree of members that are above the 200 DMA. Again, in a positive light, this represents a lot of breadth in the market. It just means that there's great participation in this move of the Nasdaq. But at the same time, it could indicate that things are a bit ahead of themselves as well. This I thought was interesting. It goes back to kind of the just pre-pandemic, and it's the S&P 500 index in the blue line, and in that kind of pinkish line is the Goldman Sachs 50 stock index for the highest short interest names. And so, a short interest is essentially a bet that the stock is going to go down. These are individual and in most cases like institutional investors that are shorting stocks, and in this case it's 50 of those, the 50 stocks with the highest short interest, where there's the highest bet that the stock's going to go down, and that index is really plowing ahead, and it's just blowing past the S&P 500 index. And what's happened here is that the S&P 500 continues to go up, and so people that are short stock, which means that they have borrowed the stock and then sold it, so at some point they've got to buy it back to close the loan. They're feeling like, well, heck, I've got to cover my short because this is continuing to go up and I'm losing my shirt. And so that's what's happening here, is that you're having a lot of shorts that are having to cover their short because the market keeps going up, and as a result, those short interest names have really spiked up. Again, yet one more sign of exuberance in the market, of perhaps maybe a little bit of froth as well. Insider selling. I've been looking for some data on insider selling as it relates to the market, and not too surprisingly, here as we head into 2021, insider selling is really perking up. Now this is poignant for a couple of reasons. One, you've got a lot of froth in the market, and it's important to watch what the insiders are doing. And these are company executives, these are large shareholders, these are board members, these are people that ostensibly would know what's going on with the companies and kind of have that insightful knowledge, and in most cases insider type of insight, but in a legal way. So it always pays to take notice when insiders are selling, and they're obviously doing that right now. Now, at the same time, down below, you can see that the buybacks are coming back, and this is something that we knew was likely to happen in 2021. And in fact, it's kind of started playing out at the end of last year, that in the pandemic, a lot of companies said, I'm reserving cash, I'm not buying back my stock, I'm not paying dividends, maybe I'm suspending them or reducing them. But we always felt like they were going to come back, and they're doing it now. So they've got increased buybacks at the same time that insiders are selling, which is kind of an interesting dynamic. But I think the good news is that buybacks are increasing. That's getting more money back in the hands of shareholders. But at the same time, you've got a spike in insider selling, and so that raises a flag as well. Profit expectations. These are fund managers that are, and this is a Bank of America Global Fund Manager Survey. So these are institutional investors that have given their thoughts on their expectations for company profits, and their expectations are really, really high. So again, I think this is baked into the market. We run the risk of, if there's a little bit of a unfulfilled expectation, if you will, that would create, I think, ripples on the market, and that's where I think we could see a bit of a market correction, if you will. But we haven't seen this exuberance in corporate earnings since coming out of the global financial crisis, and that was a much steeper drop than what we experienced last year. But really interesting, and it will pay us to monitor this as well, because institutional investors have a lot of buying power, and they also have a lot of selling power as well. A few more charts here to show you, just kind of highlighting some of this exuberance that we find in the market. The put call ratio on the left hand, it's a really noisy line. It kind of almost looks like a, somebody tracking an earthquake. But when that see that last data point on the right of that is really low, and you've got to go back to pre tech bubble, when the tech bubble finally burst, to find this level of optimism in the market. So a low put call ratio just means that there's a much lower number of bets that the market will go down than there are option bets that the market will go up. So again, an indicator of exuberance. On the right-hand side, I thought this was really interesting from Deutsche Bank. So this is volatility control, or what we call minimum volatility type funds. And these are funds that try to take the volatility out of the equity market very purposely. And so their mandate is, if there's even a small shock in the market, they're going to liquidate. So they're not participating in the full drop, hence minimizing the volatility. And so a lot of these funds have triggers that when the markets are down 2%, they start unloading stocks. And so the risk here is that if you do have this kind of this near-term asset inflated bubble of sorts kind of get pricked and kind of drop a little bit, that these types of funds could exacerbate the drop because they're mandated to sell because of their approach and philosophy. You can see that the degree to which these firms would be exposed in a 2% downdraft, it has certainly picked up over the year. So something else to consider. And I thought this was really interesting. We've had a tremendous jump in Bitcoin. It's off its peak and actually kind of testing its near-term resistance, frankly. And then you've had Tesla, which at one point was up 700% for the year. And this is just kind of puts in a nutshell, this conundrum of where we are in the market, for two, I'll call them assets, if you will, although a lot of people don't really know what to call Bitcoin right now. You've got half of the respondents to this Deutsche Bank survey that say that Bitcoin is more likely to have than do anything else, and then Tesla, you've got 62% that are saying it's more likely that it's going to get cut in half. Whereas only you've got 19-20% that say it's more, that really don't know, and you've got 18 to 25% that it says more likely to double from here. So you got more people that are worried about it being cut in half than you do people that feel like it's going to double from here. So I think this just kind of capsulizes in a nutshell, this odd point in the market, and clearly the exuberance that we've seen built into some of these names. A quick note on treasuries. So the last month we've seen an increase in longer term treasuries. This is a manifestation of this expected inflation being built into the market. We've got two charts here. The one on the left is just the shift in the yield curve. Now we know the short-term interest rates is like 1 month, 2 month, 3 month. Those haven't changed much because we know, we've already talked about this, that the Federal Reserve is keeping their foot firmly on the throat of short-term rates until they see inflation perk up for a longer period of time. Now on the back end, the 10-year, 20-year, 30-year rates are much more influenced by inflation expectations. You can see in that pink line that kind of beginning to tilt up a little bit higher, that we've seen essentially 0.2% increase in the 10-year yield over the last month, and a little bit higher in the 20-year, and we've also seen an increase in the 30-year. On the right-hand side is the TIPS yield, the Treasury inflation protection yield, and right now that break-even yield has gone up, and then so what's doing is it's driving the overall yield down quite a bit. So this is just basically, the higher the inflation rate, the lower the TIPS yield is going to be. And this is a 5-year TIPS yield. So it's just clearly, it's clear that inflation is being priced into the fixed income markets, which really do almost a better job than the equity markets of forecasting the trends in our economy. And with the increase in our yield curve, we've actually seen this continued slide down in credit spreads. Now, this is a high yield credit spread number, and what it says is, what's the yield of a high yield bond that has less that has lower credit overall than you could get in like a risk-free rate, like a Treasury. And this index has gone down. So it just means two things. One, there's a lot of confidence priced into the market right now, feeling like there's not going to be defaults by these lower credit companies. And basically the risk premium required to own bonds of issuers with lower credit is basically gone down tremendously. That there's not a whole lot of risk being priced into it right now, which again is kind of symptomatic of strong exuberance and confidence in the market. Federal debt and interest payments. This is something I talked about in my annual update. But when you talk about the need for the government, to pay for all of the stimulus, our federal public debt as a percent of GDP is tracking straight through 100% right now. Whereas the interest expense, and this is how we can afford to do this, and this is at the root of what they call this modern monetary theory, that when you have very low interest rates, or close to 0% interest, that the net cost to your economy is relatively nil to finance this. And you can see the difference here between the public debt as a percent of GDP, which is going straight through the roof, and then the net interest cost, because the bonds, the treasuries that are being issued, have very low interest rates on them. That drag on the economy is really not that great right now. And finally, I thought I would post this from YouGov, which shows what people would do if they got their $1,400 stimulus payment. I was a little curious, since we've had rounds of stimulus already, but a lot of people are going to pay bills and put into emergency savings, which I think is a really good thing, especially individuals that also happen to have small businesses. And then pay towards debt, and then buying essentials were really kind of the key categories. But what's interesting is that there's a lot of folks that are going to be out there paying bills. Well, that will do it for the chart pack this week. A little bit longer, but there's a lot of data, a lot of moving parts, and I really wanted to delve into the subject of the potential exuberance priced into the equity market. So I hope that was helpful. If you have any questions or comments, please feel free to reach out to us, and we'd love to chat with you. Have a great week and stay safe, and we'll talk to you again soon.